You need to stop selling cash secured puts. This strategy is better. We're going to do an options deep dive in this video right now.
Hey traders, as you know, cash secured puts only make money one way. The stock has to stay above your strike price and then you get to keep the premium. But what if I told you there's potentially a better way to do your cash secured puts? So to
Let's take a quick moment to talk about what a cash secured put is. And we can use PayPal. I've got this pulled up on my account right here just for fun. So a cash secured put. Let's say, for example, you're bullish on PayPal. You can sell a put on PayPal. Now, when you buy a put, that is a bearish trade. When you sell a put, it is a bullish trade. So let's go over into Tradier and let's price out what this would look like. PayPal. Okay, so let's say that we went, I'm sure he's going to say 45 days. So let's do this October 17th. And let's say that he's selling an out of the money put. Let's say that he sold the 65s. Okay, so he's selling to open the 65s. I'm guessing, of course, things will change. Of course, things will. Is this PayPal, the same PayPal we're talking about? Yeah, I'm gonna have to adjust over here. Hang on. There we go. The 65s. Let's say that he's selling the 65s. Okay. So by doing so, he's going to take in $1.10 in credit. Wow. Making so much money here. $1.10 per contract. Okay. Incredible returns here. Now he's going to have to put up a significant amount of money for the opportunity to sell that as well. Most brokers take 20% of what the cost of the strike is. So 65 times 0.2 is $1,300. So he's risking right off the bat, his margin requirements are $13 per share, and the most that he can make is $1.10 per share. He just broke the golden rule of leverage. Never put yourself in a situation where you can lose more than you can make. Because in this case here, granted, I'm not saying he's going to lose this, but I'm saying he just put up 13 times as much as he could possibly make in margin just to put on the trade. So how much is his possible total max return? 8%. So he's structuring this trade for an 8% max possible return. Dude, if I made 8% and that was my max possible return, I'd be pretty disappointed. But that is the absolute max that you could make in this case. Okay, let's get back to the video here. But in a nutshell, selling a put, in fact, hold tight. Short put options. In a nutshell, if you're selling a put, it's like this, right? You can make a little bit as the price of the stock goes up, and it's capped. You can't make more than that, but you can lose so much. You can lose so much, and your broker is going to take so much for the privilege of you just selling the put. Okay, let's continue on.
today we're going to look at a seldom used strategy called ratio spreads. We're going to compare the two and we're going to see why they might potentially be better options
By the way, the second time I blew up my account was what they call ratio spread. Well, let's see if that's what he's going to talk about.
for your cash secured put trades. You're going to see why sometimes making a little bit less premium upfront can be a better option and potentially lead to a bigger profit. And also it's going to extend the break-even price on the downside without adding any extra risk to the trade. So let's take a look. Just a quick reminder that everything discussed is for educational
He is also a random guy on the internet. Don't listen to anything that he says.
purposes only. Risk Navigator. And what we're looking at here is a cash secured put trade on PLTR. Pretty standard sort of.
Okay, so he's going to use Palantir. So let's also use Palantir. Let's go over to the Palantir chart and we'll go to the Palantir options chain and PLTR. Depending on when he recorded this, and maybe it actually says in his video, does it say the date that he recorded it? It was uploaded just yesterday and it's doing really well, but that doesn't mean that he recorded it yesterday. Okay. I'm not sure. Let's see. It looks like he's using the 145 strike on Palantir on September 19th. So let's go to that exact same strike right now, just for fun. September 19th, 145 strike. And let's price out what it would cost to sell that one. So $2.93. Now, Palantir must stay above 145 for this to make money. Well, it's really 145 minus the credit that you've taken in. So let's move up this to 145 right there. So if Palantir goes below this point I should say, this is the insidious part of trading options, selling options, is that you've now established it must happen at this point in time. So, what do I mean by that? Because when you sell an option, the premium is going to decay on a daily basis. Okay. If you've sold the option, you are now waiting for that premium to decay over time. The very most you can possibly make happens on the day of expiration. So, this is why I say it's insidious. And I really, really vastly, vividly, adamantly encourage you never to sell options. It's because let's say that it does go down. Okay. Let's say that it goes down here. You're already losing assloads of money, so much money, metric butt tons of money, because this has a unlimited loss profile and a capped profit profile. Okay. You're already losing tons and tons of money. Now, if it comes back up slightly, okay, you're like, okay, that's fine. That's fine. You know, I've got how long? I've got 2 entire weeks from this point for it to be above my expiration, right? And then it can go up some more, and then it can come down some more, and you're not getting paid until the expiration date. And that's what I hate about selling options, is that you now have this justification in the back of your mind to already take a losing trade and not do anything with it because I'm gonna give it more. It's got 2 weeks. It's got a week. It's got 3 weeks, right? I am totally content with holding this loser and letting it get worse and worse. I did this. This is how I know. I'm speaking from experience. It's okay. It's fine. I've got all the time in the world for it to come back. Options always come back. Don't you know that whenever you sell an option, 80-90% of the time it expires out of the money worthless, which means I get to collect the full amount of premium? I know because I went through all of this insidious nature for years. Okay. So, with that being said, if this is already in a downtrend, which it's really close to being, people will justify holding it for weeks at a time, saying it's fine. It's got lots of time to make up, right? It should go back up. It should go back up. Yeah. Trav says selling options, you have to wait until the expiration date. That's how it was for him before he found Outlier. Yeah. It is a very, very difficult thing to do, right? It sounds great on paper, but in reality, you set yourself up for a huge amount of failure. Let's continue on with the video.
Sort of trade 28 delta. We're down at the 145 strike and around just under a month to expiration. We're generating about $525 in premium, and our break-even price here is at about 140. So you can see we've just got a flat profit line on the upside. That's the most.
That's interesting, right? Because now that same option is worth $293. So he sold it for $5. It's already come down to $293. So by all means, this is a great time to take profit before it turns against you.
That we can make $530. If we plug that into our cash secured put calculator, we can see we've got a 47.5% annualized return potential if the put expires worthless, which is great. And we've got nearly a 10% decrease to our break even.
Hold on. I see some flaws here. Annualized return. First off, you're not going to be doing this 52 weeks a year. You and I both know that you're not going to be doing this 52 weeks a year. So to put that in annualized perspective, I think is already overinflated. It's like taking a balloon and inflating it and saying, look how great I am, right? Look how great I am. I've inflated this to be an annualized return. Let's focus in on the trade itself. So it looks like he sold it for 528. Okay. And does it say the price? Yes, the price of Palantir at that time was 154.61. So 154.61 times 0.2. So $30.92. So you multiply that by 100. So for each one lot, he's putting up $3,000. The most he can make on the trade is 528. So 528 divided by 3092. The best he can do on this is 17%, which actually is not bad. Actually, is not bad. That's a very expensive option that he sold at the time. But bro, let's be realistic here. You're not going to do this over and over and over to get this 47% return. Okay.
Price on the downside. So really good looking trade, pretty standard. This will be something that a lot of traders are kind of looking at. What we're going to do now is take a look at a ratio spread. So with a ratio spread, what we do is we actually come in a bit closer to the stock price and we buy a put. And then instead of selling one put, we're going to sell two puts. And you can see we've still only got one naked put. The risk on the downside is the same, but we've actually dropped our break-even price all the way down to 136.5. And we haven't sacrificed that much in the way of premium. Plus, we've got this nice little profit zone here if the stock does drop Down
You know what? All right, cool. I like where he's going there. So this is a short put ratio spread. So this is what he set up right here, meaning that if the price goes up, he's going to make a certain amount. If the price comes down, he can actually make more, and he's pushed back his break even point by a certain amount. You know what? Fine. If you are an option seller, I can definitely see how this is a better setup. But in reality, if you're wanting the price of the stock to go down, why not just buy the puts on it? Why not just buy the puts on it? I really don't understand that. But that's okay. I can see where he's coming from. I can understand why he would do this.
into that zone between about 140 and 150. If we put that into our calculator, what we can do is we'll say it's going to cost us about $6.95 to buy the 150 strike put, and we're going to get 2 lots of premium of about, let's say 525. So our net premium is going to be about 355. You can see that there on the risk.
Okay. So in this case, if the price goes up, the most he can make is $3.55. Okay. 355 if the price goes up. So if you're bullish, that's awesome. The most you're going to make is 355 a share. Really? The most I can make is $3.55 a share if I'm bullish. If I'm bearish, then I can make more. It looks like it might be around $9 a share. That's fine. But if you're bearish, why not just buy the puts? To go from 155 to 144 is around $9. And then you're potentially going to make even more because of how the puts are structured. I don't know. I don't see, I mean, if you are hellbent on selling puts, I totally can see how this is a better option. I absolutely can.
Graph. That's our max profit potential above a price of 150. Now, if we compare that to our previous trade, we've still got a 31.5% annualized return potential, which is really good. We can ignore this decrease to our break even because our spreadsheet isn't set up for ratio spreads, but we can see it from the risk graph here that it's 136.5. So if I just override this value, we've actually got an 11.7% decrease to our break even. So,
and that's why people get so excited. And I was the same way with selling options, because in theory, right, it's so sexy to say if the current price is 50, well, then it can go up or it can go down to $39 on this example right here. And I'm going to be profitable the whole way, baby. Let's go all day, every day, right? It sounds great. And it was great. I had 84% win rate. 84% win rate, and I was still losing money hand over fist. Why? Because when it does break down like this, it breaks down hard, it breaks down fast, and you're going to lose potentially 6, 8, 12x the most you could possibly make here. 6, 8, 10, 12 times as much, which means if you get one trade wrong, you now have to win 6, 8, 10, 12 trades in a row to break even when one trade goes wrong. Again, if you're hell-bent on selling options, this makes sense. I get it. But I don't think you should be selling options at all. You know what? Mike says this is sexy. Yet the garbage setup, this is how Felix sucked me into his program, which costs a hell of a lot more than 82 cents a day, I'm sure.
So we've sacrificed a little bit in terms of our annualized return, but we've gained on our decrease to our break-even price, and we've also added this little profit zone here. If we think about an example of the stock finishing right at the strike price of 145, if we just sell that put option, we're going to make that $525. In this case, with the ratio spread, we're making over $800 in profit. So we've actually increased our profit zone if the stock has a little bit of a drop. So that can be quite.
And this, dude, I totally get it. This sounds sexy AF, right? Charlotte says, why do so many option trading courses teach the selling option strategies here? The reason is because when you come into the market, it's really hard to grasp that a low win rate can be extremely profitable, because people don't think about the long-term game. They only focus on win rate, right? I'm here to tell you that Mark Minervini, one of my mentors, won the US Investing Championship with a 40% win rate. 40% win rate. He won. Why? Because his wins were significantly bigger than his losses, right? If his loss was 1, but his win was 4, then his 40% win rate is enormous. But when his wins, and this is where things break. When the wins are the opposite and they're huge, I'm sorry, when the wins are tiny, and the losses are huge, even with an 84% win rate, which is where I was at, it ain't going to happen. It's not mathematically going to happen. In fact, let's not beat around the bush here. Let's go look at a Monte Carlo simulator. I love looking at Monte Carlo simulators. In a Monte Carlo simulator, the thing that I'm looking for is what is my worst case outcome. So let's just say that he had 84% win rates on this, and maybe he'll explain more of it in a minute. His average win, I don't know. We're going to use ballpark numbers. At least this is what Chris's was like. His average win may have been something like $100. All right. His average loss may have been something like 6. I'll give you if my average loss was between 6 and 12, I'll give you 800. Okay. Your expectancy before doing anything with an 84% win rate, your average win's $100, your average loss is $800, your expectancy is already negative. Let's see how great this is going to turn out. It's not going to be great at all. I'm just telling you, it's going to be awful. Your worst case scenario, you lose 35,000. Your average midpoint scenario, you lose 15,000. Your best case, everything went amazingly, swimmingly well for you, you make 1,400. This is awful. This is terrible, no good, very bad. This is what Chris's portfolio looked like, right? And let's say you're playing with big boy dollars instead. Let's say your average win is 1,000 and your average loss is 8,000. Put in big boy dollars here. Right? Your worst case scenario, you've lost $400,000 with an 84% win rate. Okay. This isn't realistic, Chris. He's not going to lose $8,000 on average, right? Let's say he loses $6,000 on average. Let's say he loses $6,000 on average. Worst case scenario, negative 181,000. Average scenario, negative 43,000. Like, it is a losing proposition to sell options because it breaks the golden rule. Doesn't matter how great your win rate is. And that's the allure, is that it can go up, it can go down, it can go sideways. Any one of these possibilities can happen. But when things go wrong, you're going to lose way, way, way more than you possibly can ever win.
Beneficial as well, because a lot of times stocks do have that little pullback into that zone. Let's now think about a scenario where the stock has a really big crash or a big drop, which is the main risk with a cash secured put. Let's say the stock drops to 130. Let's have a look. The ratio spread is going to be down about $650. So price of 130, that's our expiration line, about 650. Let's have a look at just selling the naked put or cash secured.
I hope on here that he's built in like probability of profit, things like that, because option sellers love to throw around probability of profits.
Good put, we'd be down about close to 1,000, about 970, 980. So in most scenarios on the downside, we're going to be doing a lot better, even though we are still in a loss position in this example. And again, we're just sacrificing a little bit of premium on the upside. In terms of assignment, our risk is basically the same. We've still short the same strike. And if we've got this ratio spread, we're only going to get assigned on one because the long put here will offset one of the short puts here. So the maximum that we can get assigned is 100 shares with this particular trade. Now, you might get into a little tricky situation if the stock finishes between 150 and 140, and this one might get auto
to that point. And trust me, Chris traded these. I know from experience. You see this awesome peak right here that he's so excited about? Guess on what day you actually get that? Go ahead in the chat. Guess what day do you get that actual peak? Because Chris tried this. I did it over and over, thinking I was a genius, thinking that this is the best thing to ever do. The only day of the year of the entire trade that you're getting it is the actual expiration date. On expiration date. That is it. You don't get it any other time. It can be 2 days before expiration. It's not going to do anything for you. It can be 1 day before expiration. It's still not going to have this giant peak. It is down to the hour. It is down to the minute. It is down to the exact. It's going to expire at exactly 3 p.m. Central Time on September 19th. If at 3 p.m. Central Time on September 19th, it is at $45 in this case, you will get paid that max profit. And you won't see it at all until the day of expiration. In the meantime, it's going to look like his example right here. It's going to look like that purple line. I know it's kind of hard to see, but it's going to look like that purple line until the day of expiration. Then it will fall in line with what that profit curve looks like. So even if everything goes great, if it doesn't hit that peak right there, you're not going to get paid. You're still going to take this smaller profit. And then it's like, what is the point? What is the point? I just held this for, 35 days to make $3 when I could have had how many trades in the meantime with all of that capital that I tied up? I'm glad I found you, Mike. I'm glad I found you, my friend. It is such a sexy, beautiful idea, right? Let's use pop culture. This is like Sydney Sweeney. It looks like Sydney Sweeney. I mean, it kind of does look like Sydney Sweeney if you look at it. Maybe two of those side by side, right? No, I'm saying this is Sydney Sweeney. It looks beautiful. It looks beautiful. But in reality, right, it's the Joker with the Sydney Sweeney mask on. Because at the end of the day, it's just not going to look right. It's just not going to work out. Does it look beautiful? Yeah, for sure. But she crazy, right? Isn't that a scale like hot crazy scale, right? She looks great, but boy, she crazy. Yeah, there's no way I'd be putting my money in this. But if you're hell bent on selling options, by all means, this does make sense. But I'm here to tell you, let's not. Let's put in jeans, right? This is Sydney Sweeney's jeans.
Exercised at expiration. So you might want to make sure you close that out before expiration, and you might want to close one of the short puts as well if you're in that scenario where you're in this zone here. So just something to watch out for. Again, it's a
hang on. Actually, I want to Google this. We're going to do crazy hot matrix. Crazy hot matrix. There we go. Right. This is the sexy side of selling options, right? And so many channels push this because it is sexy AF, right? This is the hot crazy line, right? The more beautiful she looks, the more incredible that this looks, the crazier of an idea this trade is. The crazier of an idea this trade is. There you go. I think we made that connection there.
It's a pretty small risk, not something that you really have to worry about, but have a plan just in case that does happen. So ratio spreads are a little bit more complicated, so it does require a little bit more experience, but I think you can see that this might be a great alternative for your cash secured put trades if you want to reduce that break-even price, sacrifice a little bit of premium, but potentially have a little bit of extra profit in this zone as well. So let me know what you think. Is this the type of trade that you might be willing to try out in the future? Let me know in the comments.
You know what? Again, if you are hell-bent on selling options, this could be great for you. I'm going to give you my perspective. Now, who am I? My name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. Now, with my little credentials out of the way, I lost over $200,000 doing this. 2 followed by 5 zeros. I lost doing this. I'm telling you right now, I made significantly more money doing the opposite of this. I'm just going to put it out there. I have made way more monies doing the opposite of exactly this. So the choice is yours. Do this, get your 84% win rate, get your best case scenario of $106,000 if you can make it happen. But in all reality, you're going to be something like me, where the average scenario, negative $40,000, turns out to be reality with an 84% win rate. You do you, boo. You do you, boo. But if you're ready to save time, make money, and start winning with less risk, I would definitely not do that. But I would click one of these 2 videos. Have a fantastic day. We'll talk soon.